Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready to get smarter. We are back at the table, and today we are stripping away the noise to focus on the signal of one of the most fascinating puzzles in the American market. Today, we're breaking down a company that is, by almost every objective metric, a masterpiece of industrial efficiency. We are talking about the juggernaut known as Old Dominion Freight Line, or ODFL. Now, on the surface, ODFL is the perfect business. It has elite margins that shouldn't exist in a sector. It has a fortress balance sheet with zero net debt. It has a dominant market position that seems, unassailable. But there is a massive elephant in the room. The stock is trading at a staggering premium. We are seeing SaaS-like multiples valuations, usually reserved for high-growth software monopolies, applied to a company that moves pallets of heavy freight on asphalt. The central tension, and the question we have to answer today, is this. Are we looking at a permanent compounder that deserves this infinite premium? Is this the Costco of trucking that you just buy and hold forever?
Or have investors fallen so in love with a perfect story that they are walking off a cliff right before a cyclical reality check? We are here to find out if there are hidden cracks in the fortress.
That's a huge topic, and the stakes are incredibly high given that valuation. Before we dive deep, a quick heads up for the audience.
Right. If you're looking to invest, we use Interactive Brokers. It's who we trust with our own capital. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time.
And while you're there, please like, subscribe, and let us know your questions in the comments.
Now, let's get into it. Pillar number 1, the business model.
Let's start with the basics, because if you don't understand the machine, you can't value the output. Old Dominion Freight Line operates in the LTL sector less than truckload. And I think for a lot of people, trucking is just trucking. You see a big rig on the highway and you think it's all the same. But LTL is a completely different beast compared to standard truckload shipping.
It is fundamentally a different business model. It's so important to make this distinction clear because it explains the entire moat.
Okay, so break it down. What's standard truckload?
Standard truckload shipping is relatively simple. Think of it like a private jet charter.
Yeah.
You are a customer, you have enough stuff, say a whole factory's worth of product, to fill an entire 53-foot trailer.
Right.
You hire a truck, they pick it up at point A, drive it straight to point B, and unload it. The driver handles the freight maybe twice. Once on, once off. It's point to point.
And because it's that simple.
It's highly commoditized.
Mm-hmm.
Anyone with a commercial driver's license and a lease on a truck can compete with the big guys. The barriers to entry are practically zero.
Right. The barriers to entry in standard truckload are basically nothing. But LTL is a different animal.
LTL is like a commercial airline network, specifically a hub and spoke system like Delta or United. Imagine you're a manufacturer, but you don't have enough widgets to fill a whole truck. You just have 2 pallets. You can't afford to charter the whole private jet, which is the full truck.
So you're buying a seat on the plane for your boxes.
Exactly. You buy seats on an LTL truck for your 2 pallets.
And this is where the complexity just explodes, right? Because ODFL comes to my dock, picks up my 2 pallets, but then they're not done. They go down the street and pick up 3 pallets from a hardware store and then maybe 2 more from a grocery supplier.
Precisely. They fill that local truck with a mix of goods from all these different customers.
And none of those pallets are going to the same destination. One is going to Miami, one to Seattle, one to Dallas. So the local driver takes all that mixed freight back to a local service center. Think of this as the airport hub.
And that's where the real chaos begins.
Yeah.
They unload the entire truck. They sort every individual pallet across a massive dock, which is, just organized chaos, and reload them onto line haul trucks that are headed in the specific direction of the destination.
And it doesn't just go straight there. That pallet might go from a local hub in, say, Ohio to a regional hub in Chicago, get unloaded again, sorted again, put on another truck,
Right.
driven 500 miles, unloaded again at a break bulk facility in Denver, and then finally put on a delivery truck for the last mile.
Precisely. A single shipment might be handled by forklifts and personnel 4, 5, maybe 6 times before it reaches the customer. It might sit on 3 different trucks.
Which brings us to what you could call the math of failure. In standard trucking, you touch the freight twice. In LTL, you might touch it 10 times. That means you have 10 opportunities to drop it, crush it, lose it, put it on the wrong truck, or miss a connection.
It is a logistical nightmare if you don't have your processes absolutely locked down.
So the product isn't just moving a box.
That is the key insight. The product ODFL sells isn't really transportation. The product is certainty amidst chaos. They are selling the assurance that despite this complex multi-step relay race, your freight will arrive on time and undamaged.
And the environment right now makes this even more interesting. We are, by any measure, in a freight recession. If you look at the data from the fourth quarter of 2025, the industry is bleeding.
It's ugly out there. ODFL saw a 10.7% drop in LTL tons per day. That is a double-digit decline in volume. In almost any other industry, retail, software, manufacturing, if your volume drops 10%, you are hitting the panic button.
Oh, absolutely. You're telling your sales team to discount the product to move inventory. You need to keep the factory running.
But ODFL did the exact opposite. And this is the first aha moment where you realize this management team thinks differently. Despite volume plummeting, their revenue per hundredweight, which is how we measure yield or pricing, actually went up. It increased by 5.9%, and that's excluding fuel surcharges.
Okay, let's pause and really unpack that because that's insane. Volume is down almost 11%, and they're raising prices by 6%.
It is incredibly counterintuitive.
Yeah.
Most companies would say we have empty space in the trucks, let's lower the price to fill them.
Yeah.
Why is ODFL raising prices when demand is falling?
Is it arrogance? Or is it strategy?
It's discipline. It is pricing power in its purest, most Buffett-esque form. They're looking at the market and saying, we provide a premium service. It costs money to run this network with 99% on-time delivery. This is the price.
So if you don't want to pay it.
Feel free to use a cheaper, slower carrier who might lose your stuff. They are intentionally sacrificing low-margin volume to defend their premium yield.
They are optimizing for profitability, not for market share percentage in terms of raw tonnage.
Exactly. They know that if they lower the price just to fill the truck with what they call junk freight, they clog up the entire network.
Yeah.
And when their good, high-paying customers call, the capacity isn't there, or the service quality slips because the docks are congested. They're absolutely playing the long game.
But you can only do that. You can only tell a customer, pay up or get out, if you have a product that people are actually willing to pay a premium for. If I'm selling a commodity, I can't raise prices when demand falls. So what is the moat here? Why do customers pay 5 or 10% more for ODFL?
We call it process power. In an LTL, the metric that matters most to a customer is the cargo claims ratio. This is a simple number that measures how often you damage or lose the customer stuff.
And ODFL's number is?
The industry's lowest. Historically, it hovers around 0.1% or 0.2%. The industry average is often 1.0% or even higher, 5 to 10 times worse.
Which sounds like a boring statistic. Stando 0.2%, Zen 0.0%. Who cares? It's all small numbers.
It sounds small until you are the supply chain manager for a major corporation. Let's say you are shipping critical components for an assembly line, or you shipping high-value medical devices.
Yeah.
If the carrier loses that pallet or smashes it, your entire assembly line stops. You miss a product launch date. You lose a multi-million-dollar client. The cost of that disruption, the switching cost of a failed delivery, is massive. It can be tens or hundreds of thousands of dollars.
So paying ODFL an extra $50 on the shipping bill is basically cheap insurance.
Exactly. You aren't paying for the truck. You are paying for peace of mind. And that reliability creates a powerful lock-in effect. Once a supply chain manager switches to ODFL and stops getting yelled at by their boss for lost freight, they never, ever want to switch back to the discount carrier.
Speaking of discount carriers, we have to talk about the anti-moat.
Yeah.
We have a perfect, tragic case study in the recent history of the industry. The collapse of Yellow.
Yellow is the ghost at the feast. They were a massive LTL carrier, one of the biggest in history, and they just collapsed. They went bankrupt and liquidated.
And why? They drove the same trucks on the same highways. They had terminals in the same cities. Why did Yellow go to zero while ODFL is worth, what, $40 billion?
It comes down to a fundamental difference in business philosophy. Yellow competed on price. Their whole strategy was volume. They said, we will ship your pallets cheaper than anyone else.
Classic race to the bottom.
A textbook race to the bottom. Because they charged less, they generated less cash. Because they had less cash, they could invest in their terminals or their technology or their trucks.
So the trucks break down more often. The terminals get congested and inefficient.
And because the equipment is bad and the network is inefficient, the service quality plummets. Freight gets damaged. It arrives late. So who leaves?
The high-value customers, the ones who pay well and demand reliability.
They leave and go straight to ODFL. So now Yellow is left with only the junk freight that pays next to nothing. It's a death spiral that you just can't escape.
It creates a Lollapalooza effect for ODFL. I want to break down that mental model because it seems like ODFL has several powerful factors compounding on top of each other.
It's a textbook Lollapalooza. It's not one thing. It's 4 or 5 things working in concert.
Okay, lay it out. Step one.
Step 1. You have the process power we just talked about, this tacit knowledge of how to run the network efficiently. That leads to trust and a strong brand.
Okay, brand step 2.
That brand power allows them to charge premium prices, 5 to 10% higher than peers. Those premium prices generate enormous amounts of excess capital. That capital is reinvested into network density, more service centers, closer to customers, better technology.
And step 4 is the magic part.
Step 4 is scale economies. That density actually lowers their unit costs because they drive fewer empty miles and can optimize routes better.
Wait, explain that a bit more. How does having more terminals lower the cost? That sounds counterintuitive.
Okay, imagine I have one terminal in a huge state like Texas.
Yeah.
My driver has to drive 200 miles to pick up a single package and 200 miles back. That's a lot of fuel in time for one pickup.
Sure.
Now imagine I have 5 terminals strategically placed across Texas. The driver only has to drive 40 miles for that same pickup. My line haul efficiency skyrockets.
Yeah.
So ODFL has higher prices and lower unit costs.
That's the spread. That's where the massive margins come from.
And those margins fund more density, which lowers costs further.
Yeah.
It's a virtuous feedback loop that literally freezes out competitors.
Yeah.
Yellow couldn't afford to build new terminals. ODFL was building them constantly.
But there is one more layer to this Lollapalooza that we have to discuss, even though it can be a bit of a sensitive topic. The labor model.
We have to talk about it. The soft power of the culture. ODFL is non-union.
Which is really rare in this industry, right?
Yeah.
Especially for a legacy carrier of this size.
Extremely rare. Yellow was heavily unionized. UPS Freight was unionized. T-Force is unionized. It's the standard for the old guard.
So what is the advantage? Is it just about suppressing wages? Because that's the immediate assumption people make.
No, and that's a critical misconception. If you look at Glassdoor, if you look at the industry data, ODFL drivers are among the highest paid in the entire sector. They are not winning by underpaying people.
So how does being non-union help then?
It's about flexibility and culture. In a union shop, you often have very rigid work rules. I drive the truck. I don't work the dock. I can't drive that route because of seniority. It creates friction and inefficiency. At ODFL, because they pay well and treat the drivers like professionals, there is a palpable culture of ownership. Drivers feel empowered. They are willing to help out on the dock if it means getting the freight out on time. They take pride in keeping the equipment clean and well-maintained.
It prevents that us versus them dynamic that can poison a workplace.
Exactly. A union, by its nature, often institutionalizes an adversarial relationship between management and labor. At ODFL, they seem to be pulling in the same direction. And frankly, you cannot have the lowest claims ratio in the industry. You cannot have that white glove service if your employees hate their jobs or feel like cogs in a machine.
So we have a beautiful business engine. It's efficient. It has pricing power. It has a cultural advantage. Now let's move to pillar 2 and look at the scoreboard. Let's talk financial resilience and capital allocation.
Yeah.
Because the numbers here, honestly, they look like a mistake when you first see them.
They do. They look like software numbers attached to a trucking company. Let's start with the big one. Operating margin. ODFL operates with a 24.8% operating margin.
Okay, for context, tell the listeners what a good trucking company usually does. What is the industry standard?
In trucking, we usually talk about the operating ratio, or AR. This is just expenses divided by revenue. It's the inverse of margin. A standard, decent trucking company struggles to break an 85 or 90 operating ratio.
So they spend 85 to 90 cents to make $1.
Right. That means they're left with a 10% to 15% margin, and they're happy with that. That's a good year.
And ODFL?
ODFL is consistently hitting an OR in the low 70s. That implies a roughly 25% margin. They're literally 1,000 basis points, a full 10 percentage points, better than their good peers.
That is elite. That is absolutely amazing. But what impresses me even more is their performance during this downturn. We said revenue is down. LTM revenue is down 5.9%. Usually when revenue drops in an asset-heavy business, margins get completely crushed because you still have to pay for the terminals and the trucks.
That's operating leverage working against you. Your fixed costs eat you alive.
Yeah.
But ODFL has defied that gravity. They defended their margins even as revenue fell.
How? How did they do that?
It proves their cost structure is highly variable. They manage their labor hours ruthlessly. If volume is down 10%, they reduce hours by a similar amount without firing their core trained talent. They optimize the line haul runs. They don't run empty trucks just for the sake of running a schedule. This ability to flex costs down in lockstep with revenue is the sign of incredible management discipline.
Now let's look at the return on invested capital, or ROIC. This is my favorite metric because it tells you how good the company is at turning a dollar of investment into actual profit.
And the numbers here are spectacular. Depending on exactly how you measure the capital base, ODFL generates an ROIC of roughly 19.6% to 23.5%.
And their cost of capital, what does it cost them to get that dollar to invest?
Their WACC, their weighted average cost of capital, is around 12%. So the spread, the value creation, is massive. It's somewhere between 750 and 1,100 basis points.
Let's just explain for a second why that spread matters so much.
It's the definition of a great business. A company borrows money or uses equity at a certain cost, let's say 12%. If they invest that money and only get a 12% return, they are treading water. They aren't creating any real value for shareholders.
And if they get less than 12%, they're actively destroying it.
Right. ODFL takes capital that costs them 12% and turns it into 23%. That is a compounding machine. They are literally printing value every time they open a new terminal door or buy a new truck.
Which begs the question, what do they do with all that cash? This brings us to their capital allocation hierarchy. It is strict, it is simple, and they never deviate.
Priority one is always organic reinvestment. They pour money back into the business, buying land, building terminals, upgrading the fleet. They treat the network as a cornered resource. They know that in the long run, he with the most best-located terminals wins.
But they generate so much cash that they can't spend it all on terminals. They literally run out of places to build. So what is priority two?
This is where it gets fun for shareholders. The cannibal factor. They are aggressive, consistent buyers of their own stock.
The cannibal. I love that term.
It refers to a company that eats itself, reducing the share count over time. They don't let cash just sit on the balance sheet earning 4%. They return it to shareholders by buying back shares, consistently shrinking the float. Over the last decade, they have reduced the share count significantly.
And then, only then, priority three is dividends.
Right, the remainder. They recently hiked the quarterly dividend by 3.6% to $0.29 per share. It's not a huge yield less than 1%, but it's growing, and it's a sign of their confidence.
But I think the most important part of their capital allocation is what they don't do.
Exactly. No diversification.
Explain that term.
You see this all the time with cash-rich companies that get bored or arrogant. Management says, hey, we're great at LTL, let's buy a logistics software company, or let's expand into Europe where we have no expertise, or the worst one, let's buy a failing competitor like Yellow and try to fix it.
And it almost always ends in disaster, a complete train wreck.
Almost always. It destroys shareholder value. ODFL stays in their lane. They know LTL better than anyone in the world, and they stick to LTL. They don't do flashy, ego-driven M&A. They don't try to be a global supply chain integrator. They just move pallets in America really, really well.
Okay, so far this sounds like the perfect stock. A great business, a deep moat, incredible financials, and world-class management. I'm ready to back up the truck and buy. But, and this is a massive but, we have to talk about the price.
This is where we have to take off the rose-colored glasses and put on our green accountant visors. The party stops here.
Let's move to pillar three, the valuation. Because if I'm looking at the chart, ODFL is trading at about $190 a share. And when I look at the multiples on this thing, my nose starts to bleed.
It is an incredibly rich, some might say eye-watering, valuation. We're looking at a trailing 12-month PE ratio of roughly 38.3 times.
38 times earnings for a trucking company that owns steel and rubber.
And a free cash flow yield of just 2.2%.
Hold on, let's put that in perspective. I can buy a 10-year treasury bond right now and get, what, 4.5%? Essentially risk-free, and ODFL is offering me a 2.2% cash yield with all the risks of owning a stock. That just doesn't seem to make sense on the surface.
It doesn't, unless you assume massive, massive growth is coming right around the corner.
Is this 38x multiple normal for them? Maybe ODFL has always traded this high because it's so good.
That's a great question, but no. Their 10-year historical median PE is about 27.5x. So we were trading more than 10 turns, or about 40% higher than their own historical average. That is a massive deviation from the norm.
So when you pay 38 times earnings, you are implicitly making a very aggressive bet about the future. What is the market pricing in right now? What does Mr. Market believe is going to happen?
Mr. Market is pricing in absolute perfection. To justify $190 a share, you have to assume a massive, immediate V-shaped snapback in freight demand. You are effectively betting that we are at the absolute bottom of the cycle, that the freight recession ends tomorrow, and that earnings are going to rocket upwards.
What kind of growth are we talking about?
The current price implies annualized EPS growth of 15% to 20% for the next decade.
20% growth for a decade. For a company of this size in a cyclical industry, that seems wildly optimistic.
It's aggressive, to put it mildly. Let's do some intrinsic value triangulation. Let's try to find the fair value using a few different methods to see if we can get anywhere close to this $190 price tag.
Okay, method A, mean reversion. This is the simplest reality check.
Right. We said the historical median PE is 27.5x. That's what the market has, on average, thought was a fair price. Now let's assume the company does well and hits the consensus earnings estimate for 2026, which is about $5.09 per share.
Okay, so $5.09 in earnings 2 years from now. You multiply that by the normal PE of 27.5, what do you get?
You get a stock price of roughly $140.
Ouch. So if the stock just goes back to its normal valuation, not even cheap, just its own average, the stock drops from $190 to $140. That's a $50 drop. That's a 26% permanent loss of capital just on valuation normalization.
Correct. And that is assuming they actually hit that future earnings target, which is not a given in a recession.
Okay, that's not good. Let's try method B, owner earnings. Let's build a discounted cash flow model.
Even if we get really bullish, let's assume an aggressive cyclical rebound and then give them 12% terminal growth, which is huge for a mature industrial company. A standard DCF model gets us to a fair value of maybe $150, perhaps $160 if we're really generous with the assumptions.
So no matter how you slice the math, at $190, there is zero margin of safety.
That is the hard, unavoidable truth. You are paying a premium that reflects peak optimism in what is currently a trough fundamental environment. The price is completely disconnected from the current reality of the business.
I want to push back on this, though. I have to play devil's advocate. Everyone knows ODFL is a premium company. It's like buying Costco or Hummies. You never get it cheap. If I wait for $140, I might never get a chance to buy in. Isn't the quality worth paying a premium for?
Quality is worth a premium. But is it worth an infinite premium? That's the danger. Let's do a pre-mortem. Let's assume we buy the stock today at $190. It's 3 years from now, and we have lost a ton of money. What happened? What are the kill criteria that could lead to disaster?
Okay, what's the number one risk?
Kill criteria number 1, pricing discipline collapse. We celebrated how ODFL raised prices while volume fell. But what if this freight recession drags on? What if it goes deep into 2026 or even 2027?
At some point, the competitors get truly desperate.
Exactly. T-Force, Saya, XPO, they have trucks to fill and bills to pay too. If they start slashing prices by 15–20% just to keep the lights on, the price gap between ODFL and the market gets too wide. Customers, even loyal ones, might say, I love your service, ODFL, but I can't justify paying a 25% premium anymore. I'm leaving.
And if ODFL loses enough volume, they might be forced to cut their own prices to defend their network scale. You can't run a hub-and-spoke system if it's empty.
And if they cut prices, those beautiful 25% margins will violently revert to the mean. If margins drop to 18% or 20%, the earnings power of the business collapses and the stock price will follow.
And kill criteria number 2.
The tyranny of base rates. This is the psychological risk, the outside view. Asset-heavy industrial transport businesses simply do not sustainably trade at SaaS multiples. It's a violation of financial gravity.
Explain that concept, the tyranny of base rates.
It means that over long periods, things tend to revert to the average. Software companies trade at 40x earnings because they can grow without capital. They write the code once and can sell it 1 million times with near zero marginal cost. ODFL has to buy a new $150,000 truck and hire a new $100,000 a year driver for every chunk of new business. It is fundamentally capital intensive.
So the market might just wake up one day and say, hey, wait a minute, this is a trucking company, not a software company.
Yeah. Exactly. It's the Cisco in 2000 problem, or the Nifty 50 problem from the 70s. You had wonderful companies that were terrible stocks for a decade because the starting valuation was too high. If ODFL's multiple simply compresses from 38x to 20x, which is still a premium multiple for a trucking company, the stock price gets cut in half.
And here is the really scary part. That can happen even if the company performs well operationally.
Yes, that's the trap. They could hit their earnings targets perfectly for the next 5 years. But if the market sentiment shifts and the PE ratio drops from the stratosphere back to a normal altitude, you lose a lot of money. That is the multiple compression trap and is what keeps me up at night with this stock.
Okay, that's the bear case. And it's a strong one. I'm feeling the fear. But we have to look at the other side. Let's look at pillar 4, the 5 to 10 year horizon. Because there are smart people who have held this stock for 20 years and gotten rich by ignoring the PE ratio. What is the long-term thesis that keeps the bulls holding on?
The long game relies on what we call cannibal mathematics.
I love that concept. Explain how it works for the long-term shareholder.
The thesis isn't just about revenue growth. It's about the denominator of the EPS calculation, the number of shares. ODFL is constantly reducing its share count. Over a 10-year horizon, if they keep buying back stock with their excess cash, that reduction acts as a powerful turbocharger on earnings per share.
So even if the actual business, the revenue only grows at, say, a modest 6% or 7% a year?
The earnings per share could grow at 12% or 13% because there are fewer and fewer shares to divide the profit by. The pie is getting a little bigger each year, but your slice of the pie is getting much bigger because they were moving other slices from the table.
And the dividends per share compound in the same way. So your total shareholder return can be in the double digits, even in a slow growth economy.
Exactly. The bulls argue that the quality of the earnings, the consistency, the buybacks, the fortress balance sheet justifies a premium price because it reduces the long-term risk and provides a secondary, powerful driver of returns.
What about the cornered resource theory? We touched on their real estate earlier. How big of a deal is that over the next decade?
This is a huge and I think underrated factor for the next decade. Think about real estate. Try getting a permit to build a massive freight terminal with 200 truck doors near downtown Los Angeles or New York City or Chicago today.
Impossible. The NIMBYism, not in my backyard, would be off the charts. Zoning boards, environmental studies. It would be a nightmare. No one wants a 247 trucking terminal in their backyard.
It is nearly impossible, and it's only going to get harder. ODFL already has the land. They already have the terminals. They own the dirt. This creates a massive, almost permanent barrier to entry. New competitors literally cannot build the network that ODFL has because the prime industrial real estate isn't available.
So the supply of LTL capacity is artificially constrained.
Which locks in their pricing power for the next decade or more. It's not just a trucking play, it's an industrial infrastructure play. They own the exclusive rights to move LTL freight efficiently into and out of major U.S. metropolitan areas.
And then you have the big macro catalyst, nearshoring. We hear this buzzword a lot. Is it real for ODFL or is it just hype?
It is very real. For decades, supply chains were built to go across the Pacific. Now, for geopolitical and economic reasons, they are moving from Asia to North America, specifically the U.S. and Mexico. We are rebuilding the U.S. industrial base. Factories are opening in the Southeast and the Midwest.
That means more raw materials moving into those factories and more finished goods moving out.
And unlike ocean freight or air freight, this stuff moves by truck. It is the lifeblood of a domestic industrial economy. And ODFL has intentional excess capacity. They're currently running their network at maybe 70% or 80% capacity. They have the doors, the trucks, and the people ready for this.
So when that new volume from nearshoring hits their network, because they have the fixed cost base already covered, the incremental margins on that new business are huge.
That's the operating leverage explosion the bulls are betting on. They think earnings won't just recover, they'll double in 3 years because of this tidal wave of new domestic freight volume.
Okay, so the bull case is strong. Cannibal math plus cornered resource plus nearshoring boom. It's compelling. But I want to invert one last time. In a 10-year view, what are the existential risks? Not just a recession, but structural disruptions. Things that could actually break the business model.
I see two major structural risks in the distant horizon that keep me up at night regarding this stock. The first is automation.
Autonomous trucks, the
Yeah.
robot drivers.
Right. Right now, ODFL's moat is its culture. They win because they have the best human drivers, they hire the best people, train them better than anyone, and retain them. But what happens if we get level 4 or level 5 autonomous trucking in the next decade?
If the truck drives itself, the human advantage completely disappears.
Exactly. If Google or Tesla or some massive tech player enters the space with robot trucks that can operate 22 hours a day, does the process power of ODFL's human culture become irrelevant or worse, a liability?
Does trucking become a pure commodity again, just a game of who has the most capital?
If the driver is just software, the only thing that matters is who has the cheapest cost of capital to buy the robots. ODFL's culture of ownership and paying drivers high salaries might become a legacy asset. If they're paying humans $100,000 a year, while competitors are using robots that cost the equivalent of $20,000 a year to operate.
They become the best buggy whip manufacturer in the world right before the Ford Model T rolls out.
Precisely. That is the ultimate disruption risk.
And what's the second long-term risk?
The Capex shock from electrification.
Right, the move to EV or hydrogen trucks.
Look, governments around the world are pushing for zero emissions. California is already incredibly aggressive on this. If regulations force the entire industry to scrap their perfectly good diesel fleets and buy electric or hydrogen trucks, the cost is astronomical. An electric semi is often twice the price of a diesel one.
And it's not just the trucks themselves, it's the infrastructure to power them.
That's the real killer. You have to upgrade 260-plus service centers with massive charging infrastructure. You would need megawatt-scale power hookups at every single terminal. The investment would be in the tens of billions of dollars.
That would absolutely destroy free cash flow.
It would explode maintenance Capex. ODFL is currently a beautiful asset-light style compounding machine because they convert their earnings to cash so efficiently. If they're forced to spend billions refleeting and rebuilding their network to meet environmental mandates, that free cash flow conversion drops off a cliff. It turns a high-return business into a capital-heavy, low-return money pit.
Those are two very serious dark clouds on the distant horizon. So let's bring it all home. We've read at the machine, the money, the price, and the future. Let's head to the outro and synthesize all this for the listener. I want to give this a score. First, on the quality of the business itself.
Quality score is HIGH. I mean, it's arguably a 10-10. This is one of the best industrial businesses in America. Unassailable moat, elite ROIC, masterclass capital allocation. It is, for all intents and purposes, a perfect business.
And the valuation score, where are we today?
The valuation score is expensive. It is a flawless business priced for a flawless reality that may or may not come to pass. A 210 on price.
And that's the conflict, right? I love the business. You fear the price.
I'm terrified of the price. The quality is undeniable, but the price is indefensible at current levels.
Let's summarize the final thesis. The bull says, supply is constrained post-yellow, the macro rebound is coming, operating leverage will explode earnings, and the buybacks will supercharge the rest. Ignore the PE, buy the quality, and hold on.
And the bear says, a 38x PE is structurally unsustainable for this type of business. If the freight recession drags on, or if the market simply re-rates the multiple to a more sensible level, you are looking at years of dead money. Or worse, a 30–40% drawdown, even if the company executes well.
So where is the buy zone? We always try to give a number. If I want to own this incredible compounder for the long term, where do I set my limit order and just wait patiently?
Right. For me, looking at the historical data and the intrinsic value models, the buy zone starts around $145 and gets really attractive down at $135.
I agree completely. At $135, you have a significant margin of safety. At $145, you are paying a fair price for a great business, which is a reasonable thing to do. But at $190, you aren't buying the business, you are buying market psychology. You're just hoping the mood stays euphoric.
And hope is not an investment strategy.
It certainly isn't. I want to leave the listeners with that final provocative thought we touched on. We spend so much time analyzing culture as a durable competitive advantage. But in the age of AI and robotics, we have to ask, if autonomous trucking becomes a reality in 10 or 15 years, does a culture of excellent human drivers, which is currently ODFL's greatest asset, become its greatest liability?
That is the multi-billion-dollar question for any long-term investor.
Thanks for diving deep with us. We'll see you in the next one.